Thanks everyone for coming out for this great session we have having today. So this is our, of course, our Remax office. You've been here for the last 3 months. But what we want to do today is talk about some investment strategies that we think would be effective in the Houston market. So I want to go over with you the agenda, what we've been talking about today. We're going to be giving you the concept, how did think tank concept even evolve? How do we come about that? We're going to give you the guidelines on how we're going to be presenting today, what the strategies are. We're going to be giving you an introduction of the experts who are going to be presenting to you today, introduce you to them. And of course, giving you a presentation about each strategy. Okay? So first one up is, how do we come up with a concept? So Samantha and I have been doing this business in this market for close to about 5 years. But over these 5 years, we have serviced over 1,000 clients. And these clients have been buying homes with us, listings home with us, or even renting homes with us. And periodically they would come back to us and say, hey Sonat, hey Kunal, I'm thinking of buying an investment home, I'm thinking about buying investment property, whether it's commercial, residential. How do I go about doing it? You can leave it on, Stephen, it's okay. How do I go about doing this? So we thought, why not strategize and share with our market share to let you guys know what we can do to enable you to make more money in real estate. How does that sound? Good? All right. So that's how Think Tank evolved. Now what we're going to do today, we have each of us doing a presentation to all of you for about 15 minutes. These presentations are going to be about 10 minutes presentation and 5 minutes of Q&A, or however you want to break it up, but 15 minutes each person what they get. All right? The next guideline what I have is that each one of you should have a sheet of paper. Was it handed out? Okay. We're going to hand out a sheet of paper to you. It's going to have some guidelines. Essentially, each one of you today has $500,000 to invest. Okay? And you can write the person's name on the check, which looks something like this. Okay? A blank check. So based on what you hear today, we want to hear from you which investment strategy most appeals to you. You can say, I want to invest all $500,000 in one strategy, or you want to break it up by 250 or 250, however you want to do it. Does that make sense? So we present to you, you determine where you want to invest, $500,000 all in one strategy, or break it up, that's up to you. Again, this is not real money, but we want to determine who had the best strategy to present today. Sir, do you mind making some more copies for everyone? Thank you. Now, who are the experts you'll be dealing with today? Of course, we have Sonat, the team lead. He's going to be talking about a strategy to invest in the 288 corridor, which is towards Medical Center going south. Then I have Stephanie over here. She's going to be talking about land investment strategy right by the Grand Parkway. Okay? Then Nina, who's over here, Nina and her husband Neil are going to be talking about investment strategy in the Stafford area. And I'm going to be talking about investment strategy for new construction homes in the Sugar Land area. So those 4 areas we'll be talking about. So first up, I have Sonat, who's going to be talking about the 288 corridor strategy. Okay? Let me put up his presentation. Let me give this to you quicker. Let me give the mic if you don't mind.
Good. All right. Good afternoon, everyone. Thanks for coming out today. Appreciate it. So my story is going to be about the 288 South Corridor. Okay, so we're going to kind of go through this. I just want to warn you in advance, I'm not a PowerPoint expert. I put it together. I just did the best I could. So it's about the content, not the pictures. Okay? So investing in real estate in the 288 corridor. So what my report is going to be, our agenda, is first, I'm going to give a little overview as to why invest in real estate. I know we have some folks in here who have already invested, some folks who haven't invested at all, and some in between. So I thought I would just kind of give some basic terminology about real estate, how it works, some different methodologies, that kind of thing. Ways to invest in real estate, why 288 will experience growth, some examples of a community to invest in, an example of a property, an example showing rate of return, pros and cons of that, as well as Q&A. So I'm going to run through this, but if people have questions as I'm going through it, feel free to stop me and ask the questions. I'm happy to go through it at that time. So first off, why real estate? So here's some reasons, common reasons why people like to invest in real estate. First off, it's tangible, right? Unlike stocks, bonds, other kinds of investments like that, People like to own houses because they can touch and feel it. It's a tangible asset. It's going to be there in the long term, whereas investments on paper are just that, investments on paper. So a tangible asset. Low barrier to entry. So anyone qualified can purchase with cash, mortgage, or alternative financing. It's not that there's a minimum requirement. I mean, yes, you have down payment requirements, but you don't have to achieve a certain level. You don't have to have a certain license. I mean, a lot of people are able to purchase real estate, especially residential real estate. That's why it's popular. Leverage. You can get conventional mortgages for investment properties with residential real estate with as little as 15% down. 20% is more common to avoid PMI. But if you use alternative financing, you can even get it with lower down payments. But just conventionally, if we're looking at just kind of basic investments, you can get investment property financing with 15% down. And an example of using leverage, that instead of putting $250,000 of cash into a purchase, you can purchase 5 properties worth $250, each assuming $50,000 down payment. So then after you've purchased 5 properties with that $250,000 of cash, you have total asset value of $1.25 million, right? So our strategy also involves using the leverage, because when you actually use leverage and get loans and kind of pace the investment that way, your returns are actually a lot better from a cash-on-cash perspective, okay? Finishing up on that, cash flow, tax benefits from real estate. You can achieve net income each month with positive cash flow while paying down your mortgage balance and receiving tax benefits. You get write-offs when you invest in real estate for operating expenses, taxes, insurance, improvements, all of those things. Appreciation, this is the big one, right? Real estate and rents, when purchased in the right areas, they generally appreciate over the long term according to historical data, right? And that's been proven time and again. And it's also an inflation hedge, right? So as prices and rents rise and value of the purchase value of money decreases, mortgage payments are locked in. If you have a 30-year fixed mortgage, hey, how are you doing? If you have a 30-year fixed mortgage, your payments are locked in, but your rents and everything like that may increase over time. So that serves as an inflation hedge. So ways to invest in real estate. We're going to be talking about myself, residential real estate, but some other ways to invest in real estate. You can do commercial real estate, either purchasing or leasing. You can buy land and hold it. You can buy land and develop property on there, build a house and sell it, build a building, rent it out. You can rehab and flip properties. That's popular. We can do that as well. You can invest with real estate companies or funds where you're basically putting in money into a real estate company. They're doing the investing, whether it's in an office building or a multifamily apartment building, anything like that, and you basically have a share of the profits, right? So there's lots of different ways to do it, but we're going to be focused today on just residential real estate purchase and then leasing. So why 288 corridor will experience some growth, right? Here are the main reasons. First off, proximity to downtown, relatively speaking. You're about 20 minutes from downtown when you get down to that Pearland, Manville, 288 Highway 6 area, and you're close to the medical center. As everybody knows, we have the largest medical center in the world right here in Houston, and they're just continuing to expand. So being close to the medical center is key because there's always going to be demand for housing and property and things like that in that area. They have land available for development. Unlike some of the areas over here at Sugar Land and so forth that are highly developed, if you kind of drive up and down 288, there's still open pieces of land up and down the corridor. So that's ripe for development. It'll take some time, but the space is there. Projected population increases. I'll kind of go through and show you how the population has increased over time and what's projected for the future. High household and median incomes. There's also a toll road expansion to increase accessibility. Some people may know about that. I'll talk a little bit about that. And the Grand Parkway expansion as well, which is going to connect 59 to 288, which is pretty impressive. So why 288 corridor experience some growth? So this is kind of the area I'm talking about. I don't know if people can see that pretty good, but 288 and Highway 6, kind of that Manville area and then going closer to town, right? So within a 10-minute drive of that area, you have a total population of about 65,000. And over the past 15, 16 years, the population has increased almost 300%. Right? So a lot of people are moving into that area, in particular Pearland, but now the growth is kind of shifting down a little bit more. And it kind of shows you some of the demographics. If you go 15 minutes, population rises to 161,000, and then so forth. And you can see that average household and the median income, 92,000, 119,000. So people who are moving into those areas have purchasing power. And people who have the purchasing power generally like to purchase homes and live in homes. So this is talking about Pearland. So a lot of people don't realize this, but in the last 17 years or so, Pearland has actually grown tremendously, even more so than Sugarland. People think that Sugarland is kind of the hotbed, but Pearland, if you look at it in 2000, the population was 37,000. And if you look at 2017, the population is 120,000. So it's grown by almost 100,000 people. That's the third-ranked city in the Houston area, besides Houston proper and Pasadena. Sugarland falls in number 5, where you went from 63,000 to 88,000. Okay, so population is growing a lot in Pearland, but what's happening is that Pearland is running out of areas for new construction development. So it's coming down further south, down 288, closer to Highway 6. So what's coming in there, I don't know if people have seen this, some big signs up there. There's a big Manville Town Center that's coming in right at 288 and Highway 6, right? This is going to be a huge development, almost 1 million square feet of space, retail, commercial, offices. They've talked about having a residential component in there as well, supermarket anchor. I mean, kind of like what's going on over here in Riverstone. They're going to do something large scale in that area, right? And it's supposed to break ground later this year. It'll take a few years to develop, but this is kind of the trend. What happens, the population comes in, the homes come in, and then people, start coming for the shops and restaurants and so forth. The commercial follows. So the big Manville Town Center will break ground later this year. They're also doing a big expansion on 288. This is also huge, especially for people traveling into the medical center. So right now the existing is just a few lanes each way. But after the project completion, you're actually going to get a toll road with 2 lanes each way going and coming. And then in the future, they may even add another lane on the main highway. So what this is going to do, it's going to allow for people to have easier access up and down 288 because traffic is horrible in these places and people want to save time. So when they have a main road with this kind of access, that'll make living in that area a lot easier to get around. So this is already in process and the project will be completed in the next couple of years. Another thing that's happening is the Grand Parkway expansion. So if you can kind of see over here, basically right now Grand Parkway, as we know, is expanded from 59 all the way up to the Woodlands. So the next phase of that, they're going to actually get Grand Parkway all the way down to 288, kind of from the backside. It's going to form an outer ring, and then it's going to continue onward. So once it's all done, it'll be kind of the next outer ring after Highway 6 and so forth, and you can basically get around the whole city. So why is that important? People living in that area have better accessibility to go back and forth to different parts of town. So then all of a sudden, living over here but working in Sugarland or something like is not a big deal anymore because you'll be able to access pretty quickly. So that'll certainly help accessibility. So here's an example of a community in that area that one could potentially invest in. And I'll kind of go through an example of a specific property and show you how numbers can work. So the community I picked was Pomona, right? This is a smaller community. It's located in Manville. It's about 2 miles from Pearland Town Center, about 15 miles from the medical center, and 20 miles to downtown. So it's kind of right in that pocket that I'm talking about. The other good thing about this community, it has a direct access off of 288 South. So when you're coming down 288 South, you take an exit, it goes into the community. You don't have to go into the feeder road and kind of around and about. It just kind of takes the exit. So I thought this one was a good one to look at. Here's the location, kind of what I was talking about. Kind of in between that Beltway 8 and Highway 6 location, it's right there. So kind of right where this growth is happening. So on one side, you'll eventually have Pearland Town Center. On the other side, you'll have Manville Town Center. So here's an example of a property that's listed right now. Listed at $280,000. It's a property but a little over 2,000 square feet. It's got 4 bedrooms, 3 baths, 1-story home. It's basically walking distance. Pomona has a new elementary school that's built in the community, which is also a nice amenity for a lot of folks. And they also have good amenities in the park, kind of like a Riverstone, but not on such a large scale, but they do have amenities there. So I just picked this property just to use it as an example. So what's happening over here is I plugged in some numbers just to give you an idea of what it looks like, assuming we get a certain rate of return. So the number I plugged in, we say we got the purchase price for $270, and we did a 20% down payment with an interest rate of 5% and a loan of 30 years, right? These are all achievable numbers based on what's current investment property rates, right? And I put some closing costs in there. I put the property tax, insurance, HOA fees, everything. I put a monthly rent of $2,300. I did some rent research in that area. $2,300 is reasonable for a house of that size with 4 bedrooms and 3 baths. I put some vacancy in there, basically accounting for some time that the house may not be leased. I put a value appreciation of 3% a year. I put a holding period of 3 years and a cost to sell of 6%. Just assumptions to kind of give you an idea of what it's going to be if I bought this property, leased it for $2,300 for a few years, and then sold it after 3 years and had to pay 6% selling costs. So you can kind of see for the 3 years invested, your rate of return is 6.43% per year, right? There's your profit when you sold $12,000. But the key over there is the cash on cash return is 20%. Because again, you did not put $250,000 into the investment, you put $50,000, or in this case, $54,000, which is 20% down. So the cash on cash return number is the key because you're not actually putting in the whole number. So that's a pretty good return based on what this is. And this is assuming a 3% per year value appreciation. That's about, $8,100 a year. There's obviously a chance it could go higher than that. There's a chance it could go lower as well, but the key is to invest in areas that are developing and experiencing growth, because what happens is as more people move in, the demand picks up and then the price is raised. That's generally been the trend. So you can kind of see what it looks like based on a 3% value appreciation. But what if I put it to 5% a year? I put the same numbers in there and I put 5% value appreciation. So 5% on 270 is a little over 10,000, 11,000. So I'm basically saying in 3 years, the house will go from a value of 270 to a value of about 305, 310. Is that achievable? Sure it is. I mean, we've seen that before, and it can certainly happen in this case, right? This is a 5% per year appreciation. But when I plug that in over here, all of a sudden your rate of return jumps up to 13, almost 14% per year, and your cash on cash is almost 50%, right? So not a huge bump up, right? Not something that's completely unrealistic, but it makes a huge difference in the actual returns, right? So it just kind of shows you that, the leverage that you can get with the real estate investment, assuming certain factors. Again, your house may be vacant a little bit longer, your price may not appreciate as much, but assuming I plug in conservative numbers, which I feel are realistic, you still can get a pretty good return, with the real estate investment. So pros and cons, pros and cons of a purchase specifically in this community. So the pros, you have a lower cost of purchase, which is more affordable for current and future buyers. Obviously, the reason why that area is less expensive is because it's developing. If it was established like a Riverstone, Sienna, Katy locations and so forth, the prices would be more expensive. But the benefit is that you're getting in at a lower price point because the area is developing at this time. New construction, so you have less maintenance requirements. One thing that people do not want to do or have concerns about becoming a landlord, they don't want to fix things, right? They don't want to have to replace the roof, deal with the AC, deal with the foundation issue, water heaters out. They don't want to deal with all of that stuff. So generally, new construction homes is a good hedge against that because people who bought new construction homes, they know that you have warranty, bumper to bumper for the first year. For the first 2 years, you have structural and mechanical warranties, so your AC, all that stuff is still covered. And even beyond that, you still have some more warranties for certain parts and so forth. So you're hedging against the maintenance requirements. And even if you still want to hedge some more, there's ways to get home warranties to even take care of those issues. It's a developing area in terms of residential, commercial, and highway construction, as we talked about. Developing areas tend to increase in value over time. And infrastructure of water retention underground, so no issues during Harvey. So I bring this up specifically in that community. So as you know, people who lived in Riverstone, Sienna, some other communities, the way these communities are designed is that the streets act as a retention area. Right? So when there's a lot of water, even not just during Harvey, but even during the tax day storm, Memorial Day flood, whatever it may be, in these communities, you actually still will have some street flooding for a period of time. And then what happens is there's the pump systems that pump out the water and then eventually drains out. okay? But the streets are acting as a retention area. They're designed to flood. In this community, what the developer did is they spent extra money and they put the retention underground. So the areas underground are flooding, but not in the streets. So during Harvey, they actually had no issues at all with street flooding or houses flooding or anything close because they did the infrastructure to prevent that. It's a little bit easier to do it on a smaller scale project than a Riverstone or Sienna, but they did spend the money to do that. So I think that's a key feature over there. Some cons about a property like this: you do have higher property taxes. Property tax rate is 3.6, 3.7, which is higher than some of the other communities that you might find around here. But you have to factor in the fact you're getting it at a lower price. As an investor, you not necessarily care what your actual rate is. You just need to know what the total cost of ownership is, right? And what your monthly payments are. But there are higher property taxes out there. In a few years, you're still competing with the builder as the community is building out. It's a smaller community, you're going to have a couple thousand homes in there. But in a few years, if you're trying to sell, depending on what's going on in the market at that time, there's always competition from the builder. And as we know, builders have the most power because if they want to sell some homes, they can always throw in some more incentives and just push the homes out, which will affect your value. So there's a potential for competition with the builder. And of course, there's no guarantee of appreciation. But that's why we play the game, right? I mean, you're banking on some appreciation to make this a good investment. And, nothing is guaranteed, but you try to line things up so you have a better chance of success. And the way you line things up is you buy in a location, you divide in an area where people are moving into, where development is happening. Like that Manville Town Center, that wouldn't be built there if those people didn't feel that that was a up and coming area. You don't just build 1 million square feet with nothing over there, right? And that's been there for many, many years, but only now it's starting to develop. People who've been in this area for a while have just seen that parcel open for a very, very long time. But now with these communities coming up, with the 288 expansion happening, with all these different things happening, now they're developing the Manville Town Center because they see the upside of it. Okay? So that's my quick spiel. So questions? I know I kind of ran through it fast, but anyone have any kind of questions, concepts, ideas, specifics? Okay.
I was looking to ask for you.
Okay.
So when you mentioned that they built the retention underneath and not use the streets as the retention area, right? Is that for the entire? Pearland area, or is that
no?
just
That's for that community.
Specific for that community. Okay.
Pomona did that. So the developer, they have a piece of land. They can start what they want to do from the beginning. So they made the decision to basically design it that way, right? And they spend more money up front, but then when something like this happened, they're doing it because of an extreme situation. So then we had the extreme situation last year, and they had no issues, right? So it's just Pomona specifically. There may be other communities that also have it, but this one I know has it because we've talked to the developer about that.
Okay, so from the second question, from the investment perspective, you mentioned the big con, which tends to turn out true in many cases, that if you have a developer developing and you're trying to sell after 3 or 4 years, the chances of that gap that you're talking about, which makes it very interesting to make investment,
right,
is the chances of not happening is higher.
Correct.
So if that is the case, then what is your recommendation on looking at properties that are already built out in the Shadow Creek area maybe, which is much more closer, right? Yes, they are built out. Yes, you're looking about 10 years, but from the property value perspective, what do you think would be the better opportunity then? Buying it there and not be affected by the price as much because there's no more development left to do, or continue to buy in the Pomona or outside? Why? Because you don't have any kind of overhead cost.
Sure. It's a great question. So my answer to that would be these days, people like to buy new homes, generally speaking, right? New construction is popular, and you have a lot of different options everywhere. Whatever part of town you go to, Pearland, Manville, Sugarland, Richmond, Katy, Cypress, Woodlands, there's always new homes everywhere, right? So in my opinion, new homes tend to appreciate a little bit more over time in a quicker time frame, because in 3 years or 4 years, your home is 3 or 4 years old as opposed to 13 or 14 years old, right? We have clients that come to our office and we ask them, okay, you're looking in this area, we'll look at the new home options, would you consider resale homes? And then we ask, and they say, yeah, as long as it's not too old. And we ask them, what's too old? As long as it's not more than 3, 4, 5 years old. Like in their mind, 5 years old is like old for them in some cases, right? So when you have a lot of new construction around, I agree with you, there's a benefit to buying in a community that's already sold out, right? But at the same time, when people have new options all around, it's kind of hard to compete with the new option, right? People will tend to go towards the new option. And again, certain things factor as well. I mean, school zoning, et cetera, all those things kind of factor in. But when you have an older home, then you got to factor in the maintenance. Right? I had minimal maintenance cost up there because in 3 years, you really shouldn't have to do anything. You know, the home is brand new. You should not have to sink any more money into it. So next thing you do, you put $4,000 or $5,000 into an AC unit or something like that. That's seriously affecting your numbers, right? So that's why I would think new construction is a little bit better way to go. The hedge is that, yes, you're competing with the developer, but hopefully by that stage, they've even increased the price more. So as long as you have some gap between yourself and the new construction, like when I'm giving that example that house can be at $300,000 or $310,000, I'm thinking by that time at 3 years from now, because of demand, because of building cost increases, because of just historical data, the builder is going to be selling at $320,000, $330,000, $335,000, something like that. So if your house is selling at $300,000 or $310,000, that's the benefit for the buyer to buy your home versus the new home. They're saving money. It's kind of like buying the slightly used car versus the brand new car. There's always benefits as long as there has to be some gap. The only risk, as I said, is if the market shifts and now the builder is selling the home at $300,000 or $310,000, well then you can't have the gap. Then you're kind of a little bit more flat, but then that's how it is with any investment, right? It can go up, it can go down, it can stay flat.
Just to help your case, which I should not be doing, but then if you see the case in point of Grand Parkway where we have Richmond area, we have Aliana and Harvest Green communities. Now Aliana is relatively established neighborhood, but before Grand Parkway came in, the prices in Aliana were not as high as they are today. There was not as much demand. But once Grand Parkway came in, the demand went high, and then now you have all the new developments happening close to Grand Parkway. Same case in point on the 288 corridor. I mean, the biggest complaint we get from potential buyers and investors is, well, I get bottleneck going into downtown, going to the medical center on 288. So the next few years, once you have that toll road built in and that's in place, where the price is going to go?
Right.
So to your point, yes, it may not be a short-term investment strategy, but this is definitely a 3 to 5 year investment strategy. We'll wait for toll road to come in, buy a community which is south of Shadow Creek, Pomona, or the ones further south, Meridiana kind of communities where they're still booming and good amenities. And then once the toll road comes in, direct access makes it much better.
The road is almost completed because I travel every day from downtown to Garland. So
the progress is fast, right?
And they're having that direct connector into the medical center, right? Like yeah.
I drive from downtown to the Garland in the morning.
Right.
My question is that I think you just touched the residential. What about buying residential land or commercial land?
Sure. So, I mean, that's also a possibility, right? So then that takes more funds, that takes a little bit more capital, more everything, right? So we can kind of go down the line. There's a lot of opportunities to do something like that, and we're going to have someone kind of talk about land available today and stuff like that. But yeah, I mean, if you see that land available on 288 corridor, you could buy it. You could develop like a strip center or office space or something like that. Bigger risk, but certainly much bigger return. Like this was more of a kind of easier investment, lower kind of residential real estate, easier to get into. But absolutely, if there's opportunity there, if there's growth there, it's like people who bought land and put buildings on Grand Parkway. We know some people who have done that. They're doing very, very well because they secured the land, they developed a strip center, and now all these tenants are moving in.
If you go all the way to 288 and towards the 99, there bigger land would be available, and it's a long-term investment. You leave it there for 5 to 10 years.
Right.
But when the 99
when it connects. Yes.
That's when you're going to make your money in 10 years.
Absolutely.
Not 3 years.
Another example I'll give you, Dr. Hassan, we have a developer by the name of Rice, R-I-S-E. They are a Vegas-based company, and they have just 2 developments in the Houston area. One is on 288 corridor, community called Meridiana, and one is on I-10 called Cane Island. And they put millions and millions of dollars in these developments. So they are strategic about where they put the money. And only 2 locations they picked were I-10 and 288, right? So to case your point, where if you are on that corridor buying a parcel of land, whether it's for commercial development or strip center, whatever it may be, you cannot do that for next 1 or 2 years, but lock that up for next 5 or 10 years. There's also projection that on further south on 288, probably about 20, 30 miles south of Highway 6, they have plans of putting a NASCAR racetrack over there. So when all those things come in, guess what? The 288 corridor from downtown Medical Center is going to be the main lifeline for the city. Any other question, anyone?
Yeah.
Yes.
Sorry. Was there any particular reason why you chose 3 years for your illustration?
Sure. So I kind of wanted to illustrate that you should kind of go into a mindset. At least 3 years, you should plan to hold it, right? Because in years past, in 2013, 2014, when the market was hot, people could literally buy a home, and 6 months later, it's gone up by X dollars because builders were raising their prices like super fast, and the market was having trouble keeping up with it, right? So real estate is really more of a longer term play, right? So in this particular issue, I put 3 years because in 3 years, that area is going to look a lot different, right? With the construction completion, with the Manville Town Center, with the 59 getting connected, to Grand Parkway extension. So in my mind, minimum you should plan for 3 years. Could you hold it longer? Of course. And the longer you hold, you should have better returns.
Okay.
Right? That's the idea behind it. But 3 years should be a minimum time frame that you would plan to hold this investment.
Okay. You had a question, Dharmendra?
Yeah. So do you have price trend from in this area? Any pricing trends for last 2-3 years?
Sure. So, I mean, it kind of depends from community to community, right? Depending where you are, schools in zone 2 and so forth. So this is a relatively new community, but there has been some increases over there in prices, right? Like, so the house that I was showing to you at 280, initially when they started selling those products, they were like 250, right? 260. Now, $20,000, $30,000 maybe doesn't sound like a lot, but when you're only investing a down payment of $50,000 and you're getting a $20,000, $25,000 increase, well, that's a pretty good return, right? So that's what people have experienced over there in the last couple of years. If you were the first one in, granted, nobody's around you and nothing is there, but you're getting in at the lowest price.
I'll give you an actual example, Dharmendra. I used to live in a community called Lakes of Savannah. It's right off 280 and Highway 6 intersection. I lived there for almost 8-9 years. And back in 14, I sold my 2,600 square feet home for about 190, 191, somewhere in that range. And about 3 weeks back, we helped a client buy a similar-sized home in the same community, and they paid close to $250,000, $250,000, $260,000, somewhere in that price range. Okay. So yes, this home that they recently sold was a newer construction home, but to get a price appreciation from 15 or 14 to today, a home sold for 190, now they're selling in the 250, 260 range, is a reflection of where the prices are headed in that area.
Right. That's why more development is going on over there. So, yeah.
But my thing is, like, when, let's say you buy it today, you hold it for 3 years, you're still paying taxes on it. So, like at the end of the day, after 3 years, even if you sell it for, let's say, 305, you're making a profit of 30,000, but you paid 8,000 in taxes for 3 years.
Sure.
So it's not a big gain.
Right. Well, you're also assuming that you're leasing the home during that time.
Yeah.
Right? I mean, the rent over there, given the size of the home and the location, about $2,300 is fair. So given those numbers, you have monthly positive cash flow, including the taxes. Like I factored in the taxes number in insurance and HOA fees and basically everything. So that covered all of those things. So unless you plan to keep the house vacant or, and use it sometimes, you should have it leased for the majority of the period. So that kind of hedges that.
So, kind of depending on her question, so the rental is an important component of this calculation.
That's correct.
Right? And I noticed, I don't know that school district is probably not so prominent, or I don't know, is it? So how easy it is to get it rented out? Or that 5% vacancy, is that fair enough, or could it be higher?
Sure. So 5% vacancy is used a lot of times, but in this particular case, there's not a whole lot of rentals in this community. It's kind of a newer community, so there's not a whole lot of rentals there. But the few that have been on there have rented fairly quickly. And the reason is the location. The location is easy to get into town, right? And there's also a good elementary school that just got built right in the community, right? So people who are renting over there or living over there, they're not necessarily in there for the long term where they're thinking all the way elementary, middle school, high school. You might have first-time buyers in there, the size of the home that they're looking at, maybe they just got married, maybe they have one child, a young child, that sort of thing. You definitely don't have the big families living in a home that size, right? So for the target, there's demand for it because of the location, because it's 15 miles from the med center, and because you have amenities, and because you have an elementary school in the community. So those are the kind of things I looked at.
Any other questions? You good? Hey, good job, then.
Okay, thank you.
Stephanie? Come on. You can get the phone.
Hi, how are all of you? I wanted to thank you all for coming, and you're going to hear about different strategies from each one of my team members. But as we move forward, I wanted you to keep in mind that none of those opportunities would be available if not for the land that it was built on. So that brings me to the topic that I'm going to be talking about the advantages of purchasing vacant land. Okay, a little bit about me. I'm a licensed realtor. I have over 20 years of experience in the real estate industry, which includes selling vacant land for both residential and commercial purposes. Okay. Why should you invest in vacant land? Number one, scarcity. If you consider supply and demand, there will always be a demand for it, but at some point in time, the supply will be limited. And of course, they're not making any more of it. Flexibility. You can create the investment opportunities that you envision. Whether you're thinking about just purchasing a piece of land to build a home to sell, if you're looking to buy land to make a community, or even for commercial purposes, there's so much that you could do. Potential for growth. Overall, vacant property does track well within the market, and it can be a better long-term solution for your investments. Opportunity is everything. So what you need to do first is kind of identify your long-term goals. Are you looking to hold and resell? Are you looking to purchase land to someday be able to build your own home on it? Are you looking to build commercially? Look at the target market. Will there be a need in the future for new homes, new development, new infrastructure? Research. It's really important to partner with a knowledgeable team of professionals that can help you assess the areas and the investments that you're looking at. Okay, growth. From 2011 to 2015, Houston overall was adding 30,000 plus residents a year. That was of a growth of about 3 to 5%. It slowed down a little bit after Harvey till about 1 to 2%, which is very healthy growth. Anything over that in the 3 to 5% range, what happens is you're going to have a need down the line for more infrastructure. Okay? Pose for the future. When looking at investment opportunities in the future, it's very important to look at the past. 20 years ago in Sugarland area, it was farmland. You could buy an acre of land for $10,000. Large parcels of land are still available for future communities for fractions of the cost in more suburban areas. Currently, off of 1462, which is where I live, in the Neville-Damon area, just south of Brazos Bend State Park, there's 2,000 acres of land for sale at $2.5 million. That's $1,250 an acre. If you were to buy 2,000 acres of unimproved land in the Sugarland area, you would be looking at tens of millions of dollars.
If you can find it.
If you can find it. You probably won't. 5 reasons to buy vacant land. It's hands off. Forget construction, forget renovations, forget tenants calling you all times of the night. Other than maintaining the property itself, you have very little to do as your investment grows. Statistically, raw land owners are motivated. Many of these people, especially if you go towards Needville and Damon and those areas, have held onto this property for a very long time. Many of them, it was in their families, and they really don't see the long-term value of it. Many of them are absentee owners, and they're really motivated to sell their property. No competition. A lot of investors see more value in doing flips and in buying rental properties. If you have gone ahead and tried to invest, you know that you've probably been outbid many times on properties. There's not a lot of people that want to buy vacant land because it is a long-term investment. Little or no overhead. You don't have to worry about insurance or repairs. Okay, what you do have is you do have your taxes, but you can also get agricultural exemptions to minimize that expense. Okay? Long-term appreciation potential. Considering that the land will stay in the same condition that you bought it in, other than, of course, when natural circumstances happen, if you buy the land correctly, overall, it's going to maximize the investment. Where to begin? Identify the next big area. This is the area that I was kind of focusing on, which is the extension of the Grand Parkway. I actually live south of this area near Brazos Bend State Park. We lived in Sugar Land for a long period of time. We wanted land. We didn't want to pay $100,000 an acre. We knew we wanted more than 5 acres of land. So this is the area that we went to. Right now, I actually am going to be selling 8 acres of land for under $150,000. Okay, so you see where all of this is. These are the surrounding areas. You can spend hundreds of thousands of dollars for acreage property for residential use in the Sugar Land area. This expansion is proposed along the Grand Parkway extension. It's still a couple of years out. They're starting to expand it just north of George Ranch High School.
So this is by Highway 6, Grand Parkway, 99, the one that hasn't been built yet.
Right, so they consider that Crab River Road. So just south of 59 is Crab River. So they're starting to expand that now near George Ranch High School. So you'll see the road being expanded.
So that's past the railroad line going further down?
Past the railroad line. And so south of that, it's actually going to go down a little bit further. Right now, I mean, I live there, and it takes me sometimes 30 to 40 minutes to get home with all of the traffic and everything. We love living out there because we have a lot of acreage. It's beautiful. So we don't mind that commute. When that comes in here, it's going to shorten our commute about 20 minutes. So it's going to take maybe 20, 25 minutes in order to get to those areas. There's a lot of land available. Right across the street from the neighborhood that I live in is that 2,000 acres. That's $2.5 billion. That's $1,200 an acre. So you consider that for long term, it's nothing that you're going to make a lot of money in the beginning. You're really going to have to hold it, wait for these areas to expand. Because if you look at 99 from Katy on, when I moved here in 2005, there was nothing there. Once Grand Parkway came in, they started adding those neighborhoods, started adding those, the residential and the commercial areas, and it's just boomed. And that's what you kind of anticipate happening along this corridor. You're looking probably 5-10 years or more. So long term, it's going to make you more money than the rentals, than the flips. And just in summary, if you wanted more immediate returns, then you're going to look at those flips. You're going to look at those rentals. But if you're looking to have phenomenal long-term, investments or wealth for your family for generations to come, then you want to consider the land investments. Okay, thank you. Did y'all have any questions?
Got a question?
So something that close to, you showed a lot of things. I mean, I was not so much aware of that area, but close to 99, wouldn't that be 5 years goal rather than 10 year?
Well, you're looking at, if you go, it's about 13 miles from where 99 is, where 59 is, all the way down to the end of that expansion, about 10 miles. So what's going to happen is you're going to see the beginning of that start to expand. But a lot of the land that's relatively cheap right now in Needville and Damon and Rocheron, that's a little bit further out because you're going to grow out those areas that are closer to 59 first.
Stephanie, you talked about absentee owners. What are those?
That's people.
You talked about absentee owners. We actually looked at a couple of those parcels earlier.
Right. Oh, did you?
So there's a big church right when you cross the railroad tracks. On the left-hand side, there's a huge church which was being sold with the building and everything. Mm-hmm. And what is the absentee owners? How do you deal with them?
So that's people that have actually left the state. I mean, a lot of times in these small towns like Needville and Damon, these properties have been in the family for a long period of time. What happens is a lot of people hold on to the properties, but then they may have moved on. So you'll see a lot of that with the small towns and the large parcels of land. So that just means they're not there to manage it. They want to sell it. They can't do anything with it. They're not planning on building on it in the future. And usually just through tax records, and that's something that, your real estate agent can help you with. But there's ways to get their, information and to be able to approach them.
Is there any REIT moving in over there?
I'm sorry?
Are there any REITs who are buying?
Like a real estate investment trust? That's
Yeah.
what you mean, like buying land over there?
Not so far. Where I live, that's not really happening right now. I live a little bit further south. Like I said, I'm right next to Brazos Bend State Park. It's a beautiful area. It has, they have these beautiful old oak trees, these, elms. So
Yeah. I've seen that. Stephanie, I'm aware of that area. Fully aware.
Okay. Yeah, so I'm right here. This is where, so Brazos Bend State Park is right there, and I'm just south of that, the neighborhood that I actually live in. We bought 8.5 acres there, and then we have a property that has 5 acres on it. We wanted a lot of acreage, so we knew that we couldn't get that in like Fulshire or Richmond because we wanted so much acreage and we still wanted to be able to build. So we went down there, but we took into consideration that this was going to be happening. So for us, as a long-term investment, we took that into consideration. There's acreage within the neighborhood that I live in, 2 or 3 acres for $50,000.
Question. Now wait for the mic.
Yes, Benny.
So I have to repeat myself.
But you're loud enough. It's okay. We can all hear you. Go ahead, Benny. Take the mic.
So question. So
Sure.
this is for long term, right? So 10 years, 15
Definitely
years,
long term.
depending upon how the progress happens. Now, in those 10 to 15 years, what opportunities do you have to do with the land? Let's say, what can you do?
There's not much that you're going to be able to do because you are holding it long term. Now, when I talked about like being agriculturally exempt, it's still farmland out there. So if you purchase these properties, you could still lease it out to others that could possibly use it. So they're covering your expenses for your taxes and maybe even making you're going to be exempt from it if you get the agricultural exemption, but you can get a little bit from that. You can even harvest hay. There's things that you can do to kind of minimize any cost that you have in the short term, but you're really looking at that long term. Something to think about is that some of the richest people in the world, if you were to look at those portfolios, you're going to see real estate investments. But the majority of that is going to be in land because they see the long-term potential for it.
And I totally understand that. I think some of my friends, those who live on I-10 Sealy area, they've seen 300%, 400% growth in their land value from when they bought it to where it is now, and they've gone from 20 to 30 to 40 acres of land as they grow. And I'm talking 10 years ago. So here, the other thing they were saying is that land is so fertile, so you could do certain things. However, in this part of the area, the land is not so fertile, as I understand. And
not where I'm living, because we have, if you go down, go to Brazos Bend State Park one day. It's a nice little thing to do on the weekend with your family. And as you go down there, you'll see cotton fields, and you'll see the hay being harvested, and you'll see rice fields, and then you'll see all kind of, people have their cows out there. So there's so much farmland, and it's definitely fertile because you can see it the route all the way down that I'm talking about. So there's something, that can be done with that kind of in the short term.
And was this area affected by Harvey?
I mean, it was. You have to think, some areas were. Now, I have the 8 acres that I have that's nearer to Brazos Bend State Park. It did have some flooding on it. It needs to be built up. Once it's built up, then there shouldn't be any problems. But this is a 500-year flood, so that's something to take into consideration. The property that I have, which is closer to 1462, did not flood. I mean, there was water on the property, but the home itself didn't flood. And then there's areas that, of our neighborhood, 400 homes, only about 10 or 15 homes were affected. So that's something to think about. And we're right on Brazos River, right on there.
Yeah.
Another validation, Benny, that on that same corridor, we have national builders, Meritage Home and the other ones, coming up and developing new communities over there. So if they're coming in and building all this community with all the infrastructure, with the projections of Grand Parkway coming in, but that's, again, in the near future.
Okay.
Thank
you.
How much exemption they will take away? Because I know if you declare let's assume you have 50 acres and you make it a agriculture exemption, right? First of all, it's very difficult to get. And if you sell it, they take away the last 5 years. Or
I don't know that for sure. That's some information that we can get for you, but I don't know offhand. Yeah.
Because HCAD, she works for the HCAD actually, so
Really?
we know that
You
thing.
have to pay, I don't remember correctly, but it's either 2 years or 5 years.
5 years
you
of
have to-
tax you have to pay back.
Oh, that's interesting to find out because we have neighbors that have exemptions like that, and we have neighbors just down the road about a mile or two. They have like the pecan. They grow pecan
If you sell
trees.
it to somebody and they continue with the ag thing, then you don't have to pay. But if you sell it to a builder and
That
they're
does
going
that.
to
It
build
becomes a
community,
commercial
then
change
you
of
have to pay
use.
back taxes.
That's
And
interesting. Yeah.
the question actually was, are you aware of what is the county? Because I think it's going to fall under Matagorda County.
No, see, where I am, there's
Brazoria, sorry.
and then Fort Bend. So if you look at that, there's going to be areas kind of cut in half. That's Brazoria, and then half of it is Fort Bend. I personally live in Fort Bend County. Needville is considered Fort Bend County. There's areas of Damon that are Fort Bend and Brazoria. Rocheron is Brazoria County. So it just depends where the land is located itself.
Okay, thanks.
Yeah, good. All right. Thank you all.
I have one more question over there. Stephanie.
One more question?
Yes.
Okay.
Go ahead. Oh, thank you, Stephanie, for
You're
your
welcome.
presentation. Do you have any figure how much might be the return after 10 years for
No, I
any
think
type
you
of
have
investment?
to. That's what I said. You have to look at everything historically. We don't really know what those numbers are. But 20 years ago, like I said, Sugarland was farmland, and you could buy an acre for 10 grand. And now you have a 60-foot lot that you buy for over 100,000. So that kind of puts it in perspective. You know what to consider. So you think where Sugarland is, even from I-10 down this way, just how much that's grown. So if you look at it as the long-term investment, and if you hold this land, how much could that property, how much could that acre then sell for? I don't know the exact numbers because there's, you know, that's kind of all over the place, but look at the areas just, you know, outlying.
Okay, thanks.
And thank you, Stephanie. Good job.
You're welcome.
So you guys want some water, coffee, some beer, some wine? Too late? Then you can put some Baileys in there. You want some Baileys? No?
Oh my God, no.
All right, Nina, all yours.
Hi everybody, my name is Nina Patel. My partner and I, Neil Patel, he's my husband. He's actually with our greatest investment, our 3 children. So, no, I'm just kidding. He's actually helping some clients with some servicing. So he's not here, but I'm here to present today to you on how best to use your $500,000 that you have on hand today, okay? So, oops, sorry. So a little bit about Neil and I, that's my husband. We're experts in the area. We've been in the area, living in here for about 30 years. Neil's been here for about, living in Sugarland for about 20 years, and I've joined in from Los Angeles. We're both real estate investors, so what I'm going to be presenting to you is actual stuff that we've gone through. For the past 10 years, we have bought 4 properties in total. 2 of them we bought as foreclosures about 10 years ago. We remodeled them and rented them out for about 7 years and then sold them when the market was high. And we turned our personal property in Sienna Plantation into a rental property. So I understand what it's like to be in your shoes. I know that if you have cash, you want to make sure that you're spending it in the right place at the right time, and you're looking at a return on investment. So that's sort of the mindset that I'm coming in as I'm presenting this to you. Okay? We have a corporate background. So my husband's been working in corporate America for 20 years. I've been working in corporate America for 25 years. So we're very professional when it comes to dealing with real estate transactions. We're data driven. We're not picking through which land or which property by intuition. We're looking at data. We look and analyze through critical analysis, and we use figures and facts when we're making decisions, okay? And we're brokered by the best. Seth, Kunal and Sonnet Seth have been really great mentors to our team. So if we have any questions, we go to the brothers to get their support. And of course, we have Remax Fine Properties as one of the major powerhouses when it comes to finding deals and connecting with other agents. So that's pretty much a well-rounded, overview of who we are as agents on the Seth Brothers team. So I guess I want to ask you, because I know what my answer is, but what is your number one goal when it comes to investing? What's your money off the property first? Okay. Anyone else? Make money? Right? It's cash flow, right? Oops, I'm sorry. I meant to. supposed to play? It's okay. That was my husband. He was doing the whole cash flow thing. So some of the challenges, here's one of the things that I wanted to discuss. I'm going to give you some options and what is available. But Sonnet has mentioned some of the things about investing in single family homes, right? And so as Neil and I have invested in single family homes, I'm going to kind of tell you the issues that you may have if you decide to put your $500,000 into investing in single family homes, as Sonnet had mentioned. The first one being, you're in a concentration of assets. If your neighborhood is affected by, say, school zoning or market conditions, you're locked into that real estate property, right? Tenant risk, not paying their rent, you're getting midnight phone calls, it's a headache. I mean, sometimes people call in because their fence is broken or their AC is broken, and so what do we have to do? You have to figure out, you got to get call servicing. It's very maintenance driven. Lack of economies of scale. There's a lot of large capital items such as roofs and flooding. And if something was to go wrong, all of a sudden now you're using your profits to go into paying for those rental items, right? Binary occupancy. Someone will lease most likely 1 to 2 years. And then what happens after that? You have to wait a couple of months before you get somebody in. There's a transition period. There's maybe a loss of income. So there's a lot of ups and downs when it comes to single family rental properties. Costly management. If you're not actively doing it because you have a full-time job, you may need to hire somebody to do it. So that's, again, taking away from your profit margin. And purely market-driven. So what this means is that if the economy goes down south, so does the market value of your house. There's a strong correlation between market value and single property value. So there's a lot of things that are uncontrollable within your scope, which makes single family rental properties sort of it's kind of a risky concept. So what I want to introduce to you is investing in commercial real estate. Now, if you really look at people who are billionaires versus millionaires, it's because they've added commercial properties to their portfolio. That's just a given. And Neil and I, it took us 10 years to get to a point where we can now start investing in commercial real estate because we went through the single family route, and which is traditionally what a lot of people do. They first start off with single family renting, they accumulate the cash flow, and then they move on to commercial property. If you have $500,000, why even mess with the single family? Go straight into commercial property, which is known to give massive amount of passive growth. Okay, so here's some of the advantages of having commercial investments. You build a more diversified and balanced portfolio in your real estate. Rentals are a great start for beginners, but the sophisticated investor buys commercial property to diversify. Okay, it is the fastest way for building massive passive wealth, which is why I'm assuming you're here. Greater rate of return. Commercial has an average of 6 to 12% rate of return, while the rental properties have 1 to 4. Now, this is just a very national scale. Obviously, Fort Bend County is thriving, so the numbers are skewed a little bit. But on an average, commercial real estate does have higher rate of return, as Sonnet has mentioned earlier. Value correlated to net operating income, not market conditions. When we talked about single family income, we talked about market conditions, whereas here you have greater control of your financial destiny because it's controlled by the value of the property, the net income that the property is generating. Tenant pride. Someone who's coming in and leasing your building, if you choose to have a part, is going to care about that building because obviously it's their business. They're going to care about their image, the outside, the inside. So you're not going to have someone going in, like maybe a rental property, and going in and destroying it after they've used it for a couple of years. Consistent cash flow. When you have a commercial property, someone's in there for 5 years, 10 years, and so you're not having that lag that you did with single family properties. Commercial properties also generate multiple units, which means multiple streams of income. There's lots of ways that you can make money by paying for operating cost. And then there's all these little great things called triple net lease. There's all these different leasing options where you can generate money from those as well. Okay? So what is considered commercial real estate? They're retail offices, office buildings, warehouse, industrial buildings, apartment buildings. So that's what's technically considered commercial real estate. Okay? So My recommendation, as far as recommending commercial real estate, is actually in the city of Stafford. It's literally in our backyard. And this is the actual city of Stafford and when it's located. The zip code is 77477. It's located on the east side of Fort Bend County and conveniently located on 59 Sam Houston Tollway, close to Sugar Land, Missouri City. Okay. And the reason why I feel Stafford is an excellent choice to invest in commercial property is because of their biggest mantra, no city property taxes. Okay? This city is really, really driven on helping entrepreneurs grow. And because of that, they have no city property taxes. If you look at their property taxes total, it's 2.0 compared to Sugar Land or even Missouri City, which is probably higher threes. The city itself is also really driven to helping entrepreneurs thrive. So they've really regulated the amount of policies and forms that need to be filled out whenever someone goes in to purchase property. So you're not going to have the ordinance fee, the building code, the zoning issues that a lot of Siena, Sugar Land, Missouri City cities sort of have on their tenants. They want you to start going in and making money. So if you had to have a property that you had to invest in and you knew that you didn't have to pay an extra 1% on property taxes, that's more money in your pocket.
I know Stafford is a good choice.
Yes.
Don't they have some additional taxes on the commercial side of it?
I'll have to investigate that for you because when I actually called them and they did agree that it was a 2.0 tax rate. They may have, depending upon the type of business you're planning to put in, they may have an extra tax.
Yes.
But for most of them, the generalized rule is that there's no city tax.
So
no city property tax.
Okay. Yeah, this is something which
you've considered before?
I came across this, but I was not sure that what was the commercial taxes over there.
I see. Okay.
I never sort of gone into the detail.
Okay.
But I think there's like Harris County has a large portion.
Mm-hmm.
They have a lot of parcels and they have a lot of taxes on the commercial side.
Yes.
Stafford also has a higher rate because ultimately they have to run the city as well, right?
Yes, yes.
So they do get it from the other side.
Other side?
Yeah.
Okay. Well, we'll look into that.
Yeah, I'd love to.
I'd love to be able to talk to you, Sonnet, and Kunal and I can actually talk to you about it. If you're really interested, it's something that we can really pursue and, look into for you.
Okay.
Okay. Some things about Stafford. The city of Stafford was voted 100 best places to live and launch a Fortune small business, partly because of the friendly environment. They offer also a Freeport tax, which encourages people who manufacture to come into and set up shop in Stafford. Okay? And they also have city enticements for attracting business, like incentives like cash payouts, tax kickbacks, and host of public funding. Okay? So I just generally pulled up some listings that are available for sale in regards to commercial. And if you look at the sale price, for $500,000, it's very reasonable for you to get a commercial property in Stafford. Okay, so the first one is an industrial lot where you can lease out. The second one is a medical facility. And the last one is actually land that you can use to build whatever you feel you need to. And so some of the loans that are available for commercial investments are SBA loans, CDC loans. And if you look at them, you just have to put a minimum 10%, 15% down, and you're able to really invest in a commercial property. Okay. So I thank you so much for this opportunity to introduce commercial property investments, and what better place than literally in our backyard in Stafford. It's a great choice, and if you're close by, you're able to monitor your business and its activity. That city of Stafford is growing tremendously. We have, I think, 50 religious institutions all within Stafford. It's very multicultural, And it's not the most prettiest city, but it is, very thriving. And I think it's a great location for commercial property. So as you're writing your checks out, I hope you get to choose Stafford as your choice for investing. Thank you so much.
Any questions, anyone? Any questions?
Well, do you have some kind of ROI number on this, like those 3-4 options you showed?
Yeah, I do not. This is a very high-level introduction to commercial property. What I would suggest is if you're really interested, Sonnet, Kunal, and I and Neil can actually get together and work with you on looking at the numbers. We're very data-driven. We'll look at the community and chart out a rate of return that's a little bit more accurate. My goal here was really just to introduce the concept of commercial and have you think about Stafford, because most people think about it as they're driving. They don't really see it as an investment property. And the fact that they're so supportive of entrepreneurial businesses being on board, that they're giving all these tax incentives, why not capitalize on that? And again, this is to build long-term wealth. Like, you can use the benefits of the cash flow that you're going to get from Stafford and investing in Stafford and then move on to something bigger, hotels, motels. Think of it long-term, that the savings that you're going to have from all these tax incentives can be used to build something even bigger elsewhere.
Right, but using one of these properties, won't it be like 10 times more difficult than a residential single-family home? Like, if I have to rent out a family home and I just put it on a site or talk to a broker and it gets done.
Yeah.
But if I look at like a warehouse or a medical center or those, renting out a medical center or a warehouse could be challenging, isn't it?
I think there are challenges to it, but think about it. You just have to the lease will probably 5 to 10 years. So once you get that tenant, you're going to get that tenant for a long time. You're not having to constantly every year try to find new tenants, right? And once you get a tenant, it's really passive income. You can move on to something else, whereas a rental property, you're having to maintain that. You're going to get calls. You're going to have to pick up rent. You're going to have to deal with a pet deposit or whatever. Does that make sense? This is sort of it's considered passive income.
So, question for you. All the challenges that you mentioned at the beginning that relates to residential rental, absolutely, 100% agreed. You've talked about Stafford being no tax. This is not the first time they're doing it. It's been like that, I think, for a while now.
For 1995, yeah.
Since 1995, right?
Yeah.
But still, even though it's known in the community, that place hasn't thrived as you would expect to thrive in such areas.
Yeah.
Now, that's one of the things that I have a question on, because a lot of the friends that I have, those who are in this building space, they go elsewhere but not in Stafford, knowing fully well how friendly it is. Is that because they're not other larger, is that not a very strong residential area? I'm trying to understand why it hasn't gone to the extent that it should have, given the incentives that this city is giving you.
Let me look at the data for the amount of growth. So if you look at the population right now, the average population is 21,000, okay? And daytime employees is 26,000. Okay, so they're projected, you're right, they haven't grown as much as some say Sugarland or Riverstone or, but I don't know, would you want to chime in?
If you want to chime in over here. So I'm going to ask everyone a question. How many of you in this room knew prior to coming to this meeting that City of Stafford had only flat tax rate of 2%? How many of you knew that? 1, 2, 3, 4. You were in real estate, 5. So 5 or 6 people, which is about 20% of people over here. That's the case in Point Benny. If there's not enough awareness of what City of Stafford offers, that limits people from knowing what they should do in that area. But I agree with you. There are some limitations of what amenities you have, what the crossroads are. But when we had this, what's the name of the freeway that's connecting us to the medical center? 90 drilled up in the last few years. Stafford has got on the map. There are more commercial buildings going in. There are more businesses going on over there. But in my opinion, I think it's lack of awareness. People do not know what City of Stafford has to offer. So there's definitely a lot of potential. And that's what Nina and Neil were doing today, to let you guys all know what's in our backyard. We all live over here. We can have potential to do an investment today before everyone knows about it. Would that be fair?
Absolutely, yeah. And I mean, the city itself is not a beautiful city, I have to admit that. So there may be a perception that it's not thriving. But in actuality, it is enticing a lot of businesses. And it's right now, manufacturing is the industry that's really thriving in Stafford. So,
yeah, no, I agree with the commercial. In fact, I mean, recently I think Best Buy opened a 500,000 warehouse there.
Yeah.
And I went there to pick up something, and they were mentioning that they're going to cut down the size of their nearby stores and use that warehouse to ship everything across Texas. So I think those kind of concepts that city is in a well position, near to Houston, near to those shopping areas. I think it's well positioned. But my main concern was operational wise. How do you find that kind of tenant? How do you, get into that kind of business? And that's where I feel a little bit more challenged.
Well, that's where real estate agents come into play, right? We help you with that. Yeah.
Any questions? Okay, great job.
Okay, thank you.
Do you guys need a break, or are you good to go? I'm the last one coming up, so don't worry. We'll let you out pretty soon. Let's wait for Sarah to get some water and we get started. Okay? You want some too, Benny? I'll get some for you. All right, so I'm the last one coming up. So I believe in living the American dream. I came to U.S. when I was 21. When I was 21-year-old. And when I got my first job with the Deloitte company, accounting firm, moved to Houston within 6 months, the first thing I did was accomplish my goal of living the American dream. An American dream is all about owning real estate. People who came before me, they all talked about, if you want to live the American dream, you got to have ownership in real estate. That's exactly what I did when I got my first job when I was 22-year-old. I bought a home, I brought in my sister and 2 other roommates, and those people paid my mortgage for 8-9 years. Fast forward a few years later, of course, I had a growing family. They all moved out, and I was still accomplishing my goal of being a realtor, being in real estate, and doing all those things. But truly, the change happened about 5 years back when I gave up my job in corporate America and joined my business partner Sonnet and started doing real estate full time. That's when truly my American dream started coming true. My objective in this presentation today is to decode for you and share with you my personal strategies that I've applied the last 5 years that have helped me be more successful financially. Does that make sense? Yep. All right. So what I'm going to be talking about today, focus on new construction home sales in the Sugar Land area. So on the agenda, what I'm going to do is first I'm going to talk about why do you want to buy a home or invest in Fort Bend County. Next, what I'm going to do is talk about why invest in Sugar Land. And then, of course, why new construction. I'm going to share with you insight about a new investment strategy that's available today, as I speak today, in Sugar Land. And, of course, Q&A. So we all kind of know about Fort Bend County. It's one of the most diverse counties in all of America. It also attracts a lot of businesses and owners over here. These are top 10 employers in Fort Bend County, all the way from Floor Daniel to all the way to Texana Center, Memorial Herman. These are all the employers over here in Fort Bend County area. Then, of course, Fort Bend County is projected to grow by population. So when you have a mix of diversity, companies coming over here, and the population growth, what's going to happen in real estate? It's going to boom. Okay? Next, I'm going to jump into talk about Sugar Land, where we are in right now. So why invest in Sugar Land? So that's the monumental center right by the 59 freeway. But main thing, what attracts people to come to Sugar Land are the schools. The top rated schools in all of Houston are right in our backyard in Sugar Land. Number 2, the connectivity. So if I want to go to the medical center, I want to go to downtown, I can take 59. I have Grand Parkway to go that way. I have access to 288. I have access to Fort Bend Toll Road. So multiple access points when I'm considering a suburban lifestyle. Whereas if I take my investment and go into Katy area, that's only one access in and out, which is I-10. Again, someone talked about 288, but there's something that happens on 288, even if you have the toll road, potentially you can be blocked out. Whereas from Sugar Land area, I have multiple in and out access points. The third one over here is a variable tax rate. Sugar Land is such a phenomenal city to invest in. You can buy residential homes in low tax rate as low as 2.2% or as high as 3.4%. So there's a big gap over there. Okay? That's about investing in Sugar Land. Next I want to talk about, why do you want to invest in new construction home sales? So a few bullet points over here. Low initial amount of investment. What I mean by that is, most of the builders in our market, they expect you to put down 5%, in some cases even flat $5,000 or $10,000 when you buy a new construction home. It doesn't matter what the price point of the home is, whether it's $300,000 or $500,000. So essentially, you can put $5,000 or 5% or $10,000, buy a $500,000 home, and then when the home is completed in the next 6 months, 8 months, or 9 months, that's when you take a note to pay off that home. Second bullet point, additional time to react to unforeseen market conditions. If I was to take $500,000 today, invest in commercial or invest in anywhere else, I don't have time to react. What I mean by that is, let's just say today you invest $500,000 in a commercial space where you buy a strip mall, and tomorrow Harvey happens and business is shut down. Are you going to have anyone to pay rent for you? Potentially not. Fair? Whereas when you buy a new construction home, your investment, which is $5,000 or $10,000, is secure for the next 6 to 8 months. Worst case, what happens? You don't feel secure about it, you can walk away from that small investment. But you're not going to invest $500,000 up front. Does that make sense? Okay? Third bullet point, additional marketing time to prospect buyers or tenants. So if you buy a residential home that's new construction, that's going to take 6 to 8 or 9 months to build. In the meantime, while it's under construction, as a professional, I can still prospect a potential buyer or a renter for my home. Whereas if I get a commercial space, what do I have to do? I have 3 months time to build it out and then find a tenant for it. If not, I'm bleeding the money for the construction cost. Does that make sense? Fourth bullet point, peace of mind. How many of us invest money and have the concern, what's going to happen with my investment? When you buy a new construction home, all the builders, this is driven by the Texas law, they have to provide a 10-year structural warranty, which means your roof, your foundation, your structurally, it's going to be warranted by the builder. But beyond that, almost every builder in the Houston market provides 1-year bumper-to-bumper warranty. Some builders even offer 2-year bumper-to-bumper warranty. So what that means is, if I buy a new construction home today that takes 6 to 8 months to build, if I don't have any unforeseen situation, put minimal investment in, when it's ready, I can either lease it out or I can sell it, whatever I want to do. So based on these core principles, I personally feel buying new construction homes is the right strategy to do. Does that make sense? I'll stop right here. Does anyone have any questions for me so far? No? All right. So next one to talk about is current investment opportunity. Now we all are sitting in Sugar Land, Fort Bend County. How many of you have heard of Riverstone community? Almost all of you. Fantastic. Top selling community in Texas, right? Now Riverstone community has been around for almost 15 years. What's happened in the recent past, in the last 35 to 45 days, the brand new community that's coming up that's right next to Riverstone. I'll show you on the map over here. This is a map of Riverstone community, what we see today. The parcel of land I'm going to be focusing on is right over here. You see this kind of beige color, which is not part of Riverstone? That's what I'm going to be talking about in the next slide. Okay? The section is called Clemens Crossing. This parcel of land is right next to Riverstone, over here in this part. Do you guys know where the LJ Parkway and University intersection is? You see where the Shell gas station CVS is? This is right behind that. So essentially, this parcel of land is in the city of Sugar Land. Okay? What that means is it's already been developed, and a developer came in, bought the land, which is Meritage Home, and is going to be building homes over here. Okay? Now, what's great about this section, they have 2 product lines. Yes, please.
This is the same mud of Sugar Land or separate mud?
Different mud than Riverstone. Okay? And I'll talk about next slide, remember what that actually means for tax purposes. So essentially you have 2 product lines. One is 60-foot product line and 70-foot product line. Now you would say, well, that is nothing unique. I mean, I can buy a new construction home anywhere in Houston. Would that be correct? But I can tell you this. It is impossible to find a home or build a home that's zoned to the best schools in Houston. And I'll tell you in the next slide. This section firstly has low tax rate of only 2.5%. Remember I told you the graph of 2.2 to 3.2%? To buy a new construction home in 2.5% is impossible in the city of Sugar Land. Number 2, this is zoned to Commonwealth Elementary School, Port Saddle Middle School, and Clemens High School, right? So just for you don't know what that section means, Fort Settlement is the #1 middle school in all of Houston. Commonwealth is the #2 elementary school in all of Houston. And all that we know about Clemens High School, the top rated school in the area. So if someone says today, I want to send my kids to Clemens High School, guess what you have to do? You have to buy a home that's minimum 10 years old or older. But now you can buy a brand new home with 2.5 tax rate in the heart of Sugar Land. So essentially, the developer who came and bought this parcel of land went into a long negotiating strategy with Johnson Development. And Johnson wanted X dollars to make it part of Riverstone. The developer over said, you know what, we okay, we'll make it our own community. And guess what they called it? Clemens Crossing, right? That's brilliant marketing. You know, again, of course there are talks about rezoning that can happen in Houston, can happen in Sugar Land, that can happen anywhere in the market. But based on the current market condition, based on the proximity to the schools, that is unlikely to change. Again, it's not impossible, but it's unlikely to happen. But one thing that's not going to be taken away is a tax rate of 2.5%. Now, if you buy $500,000 of any kind of investment and you're paying 3.2 tax rate or 3% tax rate, coming down to 2.5 before any deductions, that's a chunk of change for an investment strategy. Does that make sense? So I'll stop right here. Any questions so far? Yes, please.
Why is it 2.5 here and this process is 3.25 or 3.5 with both in Sugar Land?
That's a great question. So his question was, why is it 2.5, not 3.2? So in our area, what part of town do you live in?
Richmond.
You live in Richmond, okay. So for example, this part of Houston, which is Sugar Land area, there's certain parts of land which are in the city of Sugar Land. Some of them are not in the city of Sugar Land, but are physically in the Sugar Land area, and they're called the ETJ, Extra Territorial Jurisdiction. What that means is the city of Sugar Land has not acquired that land. So if you kind of heard of the community called New Territory, right? Just recently that community was acquired by the city of Sugar Land. So what happens is when a new community comes up, they have to pay all the development costs. There's a mud tax, lit tax, all the development costs. So once those bonds have been paid off and the tax rate drops over a period of time, then the city says, you know what, I'm going to take over this parcel of land. So in the case in point over here, Riverstone community is in the Sugar Land ETJ, whereas this parcel of land is in the city of Sugar Land. And because in the city of Sugar Land it's already been acquired, all those bonds have been paid off or are at a lower level, that's why it's a rate of 2.5%. Were they able to answer your question? Any other question before I go on? Okay.
How much is the mud?
So the component, I'll have to look at what exactly I determined, but the total tax rate is about 2.5%. Okay?
How many parcels are there?
There's one.
No, how many lots?
How many lots? Okay. So I believe there are about 75 or 80, 100 lots under. So it's very, very pocket community, right? So what you...
Commonwealth,
I'll answer that for you. So if I was to put my laser pointer over here, that's where the Shell gas station is, okay? And the CVS is here. And this is University Boulevard going this way. So if I come down on LJ Parkway, I'm going towards Commonwealth. This is the current section where Meritage Home is building. So it cuts in from there. There's also an access point behind the storage unit space, okay? So all the green lots that you see, these are all 70-foot lots, okay? And all the blue ones are 60-foot lots. Historically speaking, this developer, this builder has never had any land opportunities where you can build with Meritage Home with lakefront properties. It's the first time in Sugar Land market where Meritage Home has said, I'll allow you to build a 60-foot home, a 70-foot home on the water. Okay? Any question before I go on?
Is this open now?
I'll answer that for you in a few minutes. So his question was, is it open or not? I'll answer that for. Any other question before I go on? Okay. So as I'll go back to my American dream, which was about being successful and financially independent, I don't pitch things unless I believe in, okay? So I'll share something personal with you over here. I put my mouth where money is. This is my personal check that I wrote to Meritage Home a few days back to lock up and buy a home in this section. So when I'm telling you that I believe in this product, in this section, in this community, I put my money where it actually belongs, okay? So the question was, when are they going to release, correct? So the projection in the next week or 10 days, Meritage Home is going to open up to the public and allow them to buy this section over here. However, for a limited time, there's something called as not VIP, but VVIP list. which is a limited list for only 25 people. What that means is, if you give a check to Meritage Home alongside with the pre-approval letter, you get in a VVIP list, which means when they release, the top 25 people will have an opportunity to buy a home in that section on the lot of their choice. Now, one fine print, the first section they're releasing is only the 70-foot section and not 60. The price range for homes is in the mid 400s to mid 450 to 550 price range. Okay, they're projecting, it's not confirmed, they're going to offer incentives in the range of $30,000 to $40,000 in the design center incentive. The lot premiums are unknown, but if I had to project, maybe the lot premiums for lake lots would be about $30,000 to $60,000, somewhere in that range. Okay, so since they allow people to drop the checks off, they already have 10 checks in their account. So how many opportunities left right now? 15. Now, if you're number 26 or number 27, you won't have the first shot. But more importantly, this is a directive. We have access to the division president and all the management people. Every 5 sales they'll make, price increase of $5,000. I know of clients who have gone to the sales office with a check of $600,000 and told the salesperson, I'm ready to buy now. Take my money now. And salesperson says, I'm sorry, there's a process for it. I can't just take your money, allow you to buy. What I'm telling you is this. This section is going to blow everything out of the water. Now, if your strategy is to do a long-term investment, then the other strategy that you heard about today, of course, they're going to be better for you. This is a strategy where you apply today, put only $10,000 down, minimal investment, and for any unforeseen reason, if market does shifts, school zoning changes, what's the worst that's going to happen? You lose $10,000. But I'm telling you today, if there are 25 people on the VVIP list, you're going to have 4 price increases just in that bucket, which is $20,000. And what's going to happen after that? Once they release 60-foot section, which is a lower price point section, there's going to be more demand. More buyers can afford $400,000 home than $500,000 home. Then what's going to happen? The price point for every home is going to increase significantly. So you have to make a business decision today. The check, the paper that's in front of you, you can decide to put $500,000 in any of those strategies that you heard about today, or put $500,000 in this strategy. My commitment is this today. If I can put my money down for this investment strategy, and I've been successful in real estate for the last 5 years as a professional, I do what I believe in. So I would request you guys to think about it. And if you have any more questions, I suggest go to Google. Google has all the answers. But on a serious note, any questions for me? It is not part of Riverstone.
In terms of the amenities, etc.
Hold on. So his question is, since it's not part of Riverstone, what kind of amenities would you have, correct? Yeah. It's actually part of First Colony area.
Okay.
Right? So First Colony has its own rec center, all of those things, you'll have access to those.
Okay.
Next question. Any other question? You good? Okay.
So you put 10,000. 10,000 is a commitment to do what?
Great question. So his question was, when you write a check of $10,000, what does that really mean? So the pricing of these homes and the lot premiums are not confirmed. We have an idea what they're going to be. My check over there guarantees me a spot on the list. But let's just say in the next few days when they release and the pricing is not aligned with my financial goals, I'll say give my check back. What the check will do is if everything is aligned with my expectation, the floor plan, the lot premium, the pricing, then they will write the contract. So that's an earnest money deposit. So from that point on to closing, that's the only financial commitment I'll make.
This is like any other builder will take some money.
Correct.
There's nothing, there's no difference.
I'll tell you what the difference
is.
Correct. The difference is this. There are builders in this market who take 10% earnest money.
Yeah.
And if this builder had said, I'm going to take $50,000 deposit, I'm telling you, the line would be still out the door. People want to pay $50,000 for investment. Now, they may realize they may change that in the next few days. But as of today, it's $10,000. Now, what is $10,000 in the grand scheme of things? You buy a home for $500,000 with 20% down, $100,000. If that value of the home goes from $500 to $550 or $600, you've had 30-40% price increase appreciation in your strategy. Now, this is not just what I've done first time. I've been doing last 4 to 5 years. I've personally bought 7 investment homes in Riverstone, Sugar Land area, bought a certain price point, right floor plan, right elevation, right lot, right Vastu compliant, which is direction the home faces, all of those things. And over time, the demand goes up. When the demand goes up, prices go up. That is securing my future in America. And that's my American dream. Thank you, guys. So let's take a few minutes. You guys have all these papers in front of you. So as a fun contest, what you want to see is, where do you really want to invest? So it should be based on what you heard makes the most business sense to you. Feel that you want to invest long-term in land, do that. If you feel you want to invest in 288 strategy, do that. If you want to invest in Stafford business, do that. But put a dollar amount and the name of the person who presented today and say, how much would you be willing to spend in that strategy? So we'll give you a few minutes. Yes?
That's right to $10,000, right?
Be able to Kunal. Does that make sense? So just write down the number. Benny, you need a pen? I'll get one for you. I know. I can read your mind. 1 second. Does everyone have the sheet of paper? You need? Okay. Tell you have more pens? Right there.
Up to 500.
You have to invest up to $500,000 in any of these strategies. Yeah, she's getting the pen. Up to 500. So do 500. It's free money. So the question was, can I invest less? I mean, you have free money of $500,000. Where would you put it today? Yes. Yeah, yeah. Secure a position. No. So he asked me a question for this strategy that if you're at a contract today, can you sell the home before it closes? The answer is no. You can only sell or liquidate this asset after the home is completed and you get ownership of the home.
Yeah, you can't sign the property.
You cannot just sell it off. I need a pen as well, right? Another pen? What's that? Huh? Not yet. We'll count and tally all of this. You need a pen. Who's done writing the check to us? Yes. Huh? Yes, sign it. Dharminder, here you go. Put the dollar amount and put one of those 4 strategies or 2, however you want it. Tosa, why don't you write a check too? Come on. Huh? Yeah, she's taking bribes. Bribe her. Sarah, how about for you?
I'll take your check.
You good?
Yeah, I think that's it.
All right.
You have to make it 2 of this.
Total $500,000. You have $500,000. See, you have $500,000. Invest any way you want. So you're going to invest in land, in 288, or however you'll do it. You got yours? All right. That's awesome. Okay. Good. Vishal, where are you going? Fantastic. All right. You got your money in? All right. How about for you? Okay. You got yours, Dr. Hassan? Okay. Lenny Singh. You got it? Tosa.
I haven't put the money in.
I need the dollar amount.
The exact dollar amount.
Yeah. Just bring, oh, you got yours? Okay.
So this is your total. Okay. So you're looking at the down payment perspective.
No, you have you're an investor. You have $500,000. Where would you put your money?
No,
Even if you don't have it,
Yeah, but you have to put what's the breakdown. So how much with each strategy?
You can put a million.
Yeah.
who knows what everybody.
Huh. Sarah? Nice. You got yours? Okay. Great. Great. Why not? That's the way to do it. Got yours? Got it. So you have to put total $500,000. Total half. Where would you put it? Where's yours, Sarah? How about for you? You got your money in? All right. Everyone has turned it in? Everyone's in? Okay. So it's pretty interesting. Oh, Tosa? Benny? How would I know? Okay. 20% of what? Of $500,000? Do some math, man. Put the number. $100,000. It's supposed to be 2 checks. All right, so guys, what we have is a very interesting outcome over here. A lot of you thought about investing in 288 corridor, but I have a group that was really interested in investing in commercial and also on land. So I'll kind of go down the list real quick. So this one does not have the name on it. I think it's one of you. So commercial land around Grand Parkway, which is for $250,000, and Stafford commercial for $250,000. So one of them is over there. This is, I believe it's you, Sarah. Sarah wants to invest $250,000 with Stephanie, and then $250,000 with Kunal. And then I have over here with name unknown. Whose handwriting is this? Is that yours? Okay. So whoever this person is, $250,000 in Meritage and the other half in Stafford commercial with Nina.
That's mine.
That's yours? All right, Dharminder, come on, you should write your name, man.
You said check.
I should know. That's right. Dharminder.
My name is on the check.
That's true. So this one is half $200,000 to Sonnet on 2-way corridor and $300,000 to Meritage strategy. Then the next one I have is Grand Parkway, $250,000 for Stephanie. Another $250,000 for Stafford for Nina. Next one I have again $250,000 for Stafford with Nina, and $250,000 with Grand Parkway with Stephanie, which is great. Then I have next person between me and Sonnet, 250. Next one I have 250 with Sonnet and 250 with me. This is Vishal. Thanks for adding your name. And then I have this person, Tosa. Tosa wants to invest $250,000 with Nina and the other half with Stephanie, which is great. And then Anil wants to do 250 between me and Sonnet. And then this is a complicated person. He would write the dollar amount. He would put 20%. But Benny Sig wants to invest 20% of $500,000, which is $100,000 with me. Another 20% with Sonnet, and the other with Stephanie. So Stephanie got a chunk of that change, $300,000. Then over here I have 250 with him, Sonnet, and 250 with me. And then over here I have 250 with Sonnet, 250 with me. So what you can see essentially is, one more? What do I have here? Who's this? Daniel, okay. So his opinion is he wants to invest $250,000 with Stephanie on the Grand Parkway area, and the other half with new construction home sales. So essentially what you've seen is most of the people who are interested in commercial either have the experience over there or know what we're talking about. And for them to even see the other strategies, they want to put the money where the next development is. So in our opinion today, there's no right or wrong strategy. It's your appetite for investment. You want to do a short-term investment or long-term investment. You want to do investment in land, commercial, or residential. So all these strategies apply. What we can do is we can shut down the session now, but we can have more dialogue with you. So if you say, really, I want to spend more time and get more information about strategy with Stephanie, or with Nina, or with me, or with Sonnet, we're happy to answer more questions for you. What we want to highlight today was, this was a session, we want to share some strategies with you. Now again, this is not finite. There are several thousand of strategies that can be applied. What we thought about, these are the 4 most relevant strategies in the market today. That makes sense? Thank you guys for coming out today. It was a great event. Well, thanks for coming. Was it helpful? Yeah? Thanks for coming. Huh? Yes. Yeah. We'll have different topics every month. Was it helpful? Oh, you're welcome.